In the previous lecture video, we learned how newly independent nations came into being and why they are called developing countries. We also know about the objective of these developing countries, and that is they wanted to raise standard of living of their people, and this could happen with productivity increase. And there was an almost a consensus that industrialization is the key to economic development or for raising standard of living of people living in developing countries. We also learned that free trade may not be optimal for the needs and aspirations of developing countries, and we briefly looked at some arguments against free trade for developing countries. In this video, what we look at are the strategies adopted by developing countries and what has been their experience with respect to economic development in the last 60 years or so. In the previous video, we also learned that the socialist/communist countries industrialized much faster than the free market economies such as the US, UK, and so on. So a very large number of these developing countries which wanted to increase average income per person rather quickly, they in a way tilted towards the strategy adopted by socialist countries, and this strategy is called import substituting industrialization, or ISI in short. What this means is this is a strategy of industrialization that advocates replacing imports with domestic production. So whatever you import or whatever you need to import in future, what you do is you start producing those goods. So essentially what these countries are trying to do is become self-sufficient in terms of all their needs. So they wanted to produce everything or all that they could and adopt a strategy which could help them fulfill this goal. And so whatever you import or need to import, maybe at present or in future, you replace it with domestic production. So what this entailed is you import machineries that could produce machineries that could be used in different industries like textiles, making tractors, and so on. Import substituting industrialization. Now, to invest in industries, you require savings, and savings rates were rather low in these developing countries. So what they had to do is come up with strategies that could step up savings rate, and also with the available or higher savings, they wanted to channelize these savings into most efficient investments. And what they wanted to do is, at the same time, with respect to imports, they wanted to control what was imported into the country, and they wanted to limit it mainly to essential items like crude oil, also items like machinery, and so on. Now, in order to do that, what you're doing is you're going against free foreign trade. So you need to restrict foreign trade, and this meant active intervention by the governments. So over the years, what these different developing countries did is they adopted ISI strategy, and over time, because they wanted to channelize investments into their most productive use, the governments control over the economy became immense, and they controlled almost everything: infrastructure, industrial production, imports, exports. And over time, these countries developed a complex set of rules and regulations to control their economies, and they started to industrialize. And this seemed to do well initially, and then these countries didn't do as well as time passed by. Thus, 20 or 30 years of experience with ISI did lead to creation of an industrial base of whatever nature in most of these developing countries. But then this industrial structure or this industrial base was sheltered from foreign as well as domestic competition, and that meant that these industries were became very inefficient in terms of production. That means they were not very cost effective, and they were under no pressure to innovate and come up with new products, or also undertake measures which could reduce in reduction of cost. Number two, since most of the economy was controlled by the government or the bureaucracy, this led to very widespread corruption amongst government officials. And so though they were able to create some industrial base, there were problems with that because it was inefficient in terms of what it produced. And number two, the governments became extremely corrupt. So by late 1970s or early 1980s, there was an increased realization about the negative effects of ISI. And then gradually different countries undertook steps to liberalize their economies, particularly open up their economies to foreign influences, that is trade and investments. So in 30 years or so, there was a complete turnaround in terms of the role of foreign trade in economic development. So why was there a turnaround in terms of economic thinking about the role of foreign trade in economic development? In 1950s or so, people believed that foreign trade has only a limited role in economic development and that needs to be controlled or regulated. And because of different countries pursuing ISI, they became relatively closed economies. But based on the experience these countries had with ISI, they decided to open up their economies starting from late 1970s to early 1980s. So there are three major reasons as to why this happened. Number one is experience with ISI. That's something we have talked about. It led to a lot of corruption and inefficient ways to produce things. Number two, empirical research showed that countries which were relatively more open, they tend to raise average income per person much faster than those countries which were not. And what I have in mind is particularly a report by the World Bank called World Development Report 1987, where research showed experiences of different developing countries, and they found that countries that were relatively more engaged in foreign trade tended to do much better than countries those that were not, like countries that followed ISI. The third reason is also important. It was in late 1980s that Romer and Lucas came up with what is called endogenous growth models, and theoretically they were able to show that when a country is more open to foreign influences, it can gain a lot by exchange of ideas, exchange of technology, and so on. So there was a theoretical development in economics called endogenous growth models, and that also emphasized the need for foreign trade or the role of foreign trade in economic development. Though a large number of developing countries followed ISI, a few of them followed what is called an export-oriented strategy, and this is where an economy is geared more towards foreign influences, trade, and investments. Now, an export-oriented strategy is these developing countries target the export or the world market for their production. And since they are looking at the world market, they're looking at a market which is much larger than their own country. Number two, when you compete in the world market, you have to be innovative, you have to be uh, cost efficient, and so on. And so foreign influences, because of competition, exert a positive pressure on domestic industries. And so So these industries become more and more efficient, and this strategy was followed by few countries, particularly in East Asia, such as Japan, South Korea, Taiwan, and Hong Kong, and they became very successful in raising average income per person. Now, in recent times, countries which had followed ISI have now switched to export-oriented strategy or embraced a system called free market enterprise system. And just look at the two successful examples in the recent times, that is China and India. They have become relatively more open, and these countries have witnessed a substantial economic growth, and now other developing countries are also following this strategy. Now let us look at some numbers with respect to China and India, and we compare these two strategies, ISI and Export-Oriented Strategy, or EOS. Broadly speaking, I have this data from 1960 to 1980, where China and India pursued ISI, and then they switched to export-oriented strategy between 1980 and 2011. Now, the figures that I have in these tables are GDP figures which can be considered to be at constant value. That is, this is at 2005 constant exchange rate and all in terms of dollars. And look at the following. Between 1960 and 1980, GDP in China in 1980 was 2.6 times higher than what it was in 1960. What about when China followed a more open economic policy? GDP increased 19 times as compared to 2.6 times under ISI. What about average income per person in China? Under more open foreign trade and investment policy, average income per person in 2011 was 14 times higher than what it was in 1980. And what was the corresponding figure under ISI? It was just 1.8 times. So what we have seen in case of China is a significant increase in GDP and a significant increase in per capita GDP. Look at the case of India, very similar experience. 1960 to 1980, ISI, GDP grew 2 times. Between 1980 and 2011, where for most part India followed export-oriented strategy, GDP increased 6.5 times. What about average income per person under ISI? 1.3 times. What about average income per person under EOS? 3.7 times. And look at the numbers with respect to percent share in world totals. In 1980, exports of China were 0.9% of the world total. In 2011, they were 10.4%. Imports of China in 1980, 1%. In 2011, 9.5%. Foreign direct investment inflow into China, 0.1% in 1980 and 8.1% in 2011. Look at India, very similar this thing. India's exports were 0.4% of the world total. In 2011, they were 1.6%. Imports into India in 1980, 0.7%. Imports into India as a percent of world total in 2011, 2.5. FDI flow 0.2% in 1980 and 2% in 2011. So what you find is they have increased the role of foreign trade and investment into their countries, and as you can see in this part, both these countries have become better off in terms of GDP and per capita GDP or average income per person. So this is why most of the countries around the world are following export-oriented strategy. And this completes our discussion of international trade and economic development. Thank you for your time.